right, first deal we have up for today is in Chapel Hill, North Carolina, 80s vintage deal, about 150 units. Asking price is roughly 150 a unit, which comes out to a little under 22 million. This is a currently marketed deal. And if we look at North Carolina, it's definitely Chapel Hill is definitely a market that we like generally speaking. Let's take a look at the demographics specific to this property. Make sure it's consistent with the overall market. Really diverse industry in this area. Good banking, insurance, healthcare, education. If I look at the demos here, right in line with what I would expected, over $100,000 income for the 1 mile radius. And it looks like in this case, the 1 mile radius is actually better than the 3 and the 5 mile. And even the 5 mile has $90,000 income or better. So really strong income levels. Population, vacant housing wise is relatively low, under 10%. Renters are roughly 30 to 40% of the housing units, all consistent with what we'd expect. And schools are very strong, 8s, 9s out of 10s, on average 8 out of 10 for the schools in elementary, middle, and high school. Unemployment rate is very low, consistent with and below the national average. Population has been flat over the last 5 years, some very small amounts of growth, but we're really looking for stable population or growing population, not necessarily, just not significant population loss combined with other factors. So demographics wise, school wise, all looks really great. Size is great. And so looking at this one, this was recently purchased actually, and so there's got to be a story here, but this was recently purchased just about a year ago for roughly the price they're looking to sell it at. That is typically a red flag, but there's also a tax abatement here. We typically do not factor in tax abatements because they do not necessarily always stay in law during the entire ownership period, or when you sell the property, the next owner may not be as liberal with the application of the abatement. So what we'll typically do is look at perhaps what it would look like to get the cash flow benefit of that abatement, but not necessarily capitalize that lower expense into the NOI, which would then drive a higher valuation at exit. We may split the baby a little bit there, take advantage of the cash flow during the life of our investment, but then not necessarily consider it when we sell it. Looking at this overall, because of the tax abatement, these deals are very difficult to square because there will always be someone in the market who is interested in this sort of a thing, and they will consider the tax abatement. So it's just very difficult for us to be competitive on these deals, but ask some people in Texas. They recently saw tax abatements go away that were very much the basis for a lot of business plans, and a lot of people are losing a lot of money as a result of that. We definitely want to be on the right side of that. That being said, looking at this, if you were to give a sense of what kind of value difference we're talking about, if we were to take this into consideration versus not, I think that's always a helpful understanding. If we were to go ahead and adjust this for the tax abatement, we would be able to move essentially all the way back up to their ask. The tax abatement, if you consider that through the life of the loan or the life of the hold, as well as at the exit, you're looking at almost a 20% delta in value. So now if you only consider during the life of the property, right, only during the ownership period and then not at the sale, then you're going to have a lesser impact, probably about half the distance, maybe a little bit more than half the distance, depending on your hold period. In our case, we're looking to hold for 10 years, so we get a lot more benefit during that cash flow period. But with a shorter period, like a 3 or a 5 year hold, we're typically going to see a lot of that value creation at exit. So that higher EV, that higher valuation is going to drive more return delta. So that being said, this is a great deal in a great area. That if it wasn't for this tax abatement, probably I would be less inclined to you would be more likely to get this deal done, or at least be more closer to the necessary yield. So that being said, this is going to be a tough one for us. We're at about 80 cents on the dollar. Again, relative mostly to that tax abatement and the way we handle that in our shop versus perhaps the marketplace. So with that, we will get an offer in, but again, very difficult to make this one competitive for us. Next deal, we're going to move over from the Carolinas. We're going to move to Georgia next. We've got a few different deals in Georgia, all over the place. Starting, we had a couple deals in northern Atlanta in a market called Marietta, very popular. These are older vintage properties, B and C assets, 100 to 150 units built in the 60s and 70s. I'm gonna do them as a combined set. We've seen these deals before. I would say for one of them, both the vintage in 1960s is a little bit newer. I will say that, a little bit older than we want to see. We typically want to be looking at 80s or newer. We will look at 70s if it's in a really strong market. In this case, Marietta is a strong market typically, but it does matter where exactly we are in that area. So I'm going to go ahead and pull the demographics here, make sure that all checks out. That's really the beginning, and without that, it doesn't really much matter. It looks like this is in a not so great pocket of the area. So 5-mile radius, 80,000, the postal code 91, but the 1-mile radius is between $50,000 and $55,000. So really not attractive from an income perspective. That becomes an affordability issue, but it also is a indication of the wherewithal economically of the potential tenant base. So we want to be careful there. Schools just barely pass our screen. Population growth has been steady, a little bit of growth. Renter, and this is where you can see this, renter occupied housing units is over 50%. That's typically not where we want to be. We want to be in a situation where most people own their homes. There's like the tragedy of the commons situation when you have too many renters in the area. They don't really have as much vested interest in the area. So we want to try to keep that, or look for areas where the renter occupied percentage is between 30 and 40% or lower. Even better if we can be below 30%. And in some of our best deals actually are in areas where there's only 10 or 20% of the housing stock are rentals. And we have, what happened typically in those areas is a property gets built in the 70s or 80s, and then there's a big transformation and development process, but mostly for single family homes. There's a lot of industry that moves in, a lot of growth through the 80s, 90s, and 2000s. And as everything shifted to more single family homes, those apartment communities still stayed, but they didn't build new ones in that to increase density. They really focused on single family homes. So those are the areas where we can actually find the best attractive opportunities, where we have really strong household value. People can't really get into those school districts without having a really strong income. And so for most of the tenants that we're working with that are blue collar industry or just making that median income, they want to be in that school district, and their only real option is some sort of rental. And so we can provide a really strong option and a great product for folks like that. That being said, like I said, this is a 1-mile radius that is kind of a lower income pocket relative to the rest of the area, around 100 units. This property was purchased in the mid 2010s for all in about $7.5 million. So the existing sponsors in for about $85 a square foot. If I look at this property, again, not a super attractive because of the demographics. So we're going to be way off on price here. I'm currently about 21% off of the asking price. The asking price isn't that high, right? I will say that given now that being said, this was a 60s vintage. So that definitely comes into play. But if I look at this overall, at the asking price, they want a going in yield of 6.5, give or take, which is not terrible. However, given I think some additional costs versus how the existing sponsor's running it, we don't see a lot of value add here. So if I was to look at the revenue drivers here, we are looking to drive revenue about 20 to 25%. That's within tolerance for us. However, we have 70% of the units are 1 bedrooms. So we're going to have a average square footage issue. Looks like our average is okay, actually 900, but most of these units are individual 1 bedrooms, not that attractive. So a lower income, mostly 1 bedrooms, really heavy on the expenses per unit, and each unit doesn't have the most amount of rent because of some of the things I just said. So that's going to lead to lower cash flow. It's going to lead to lower values, and it's going to be really hard to overcome those things as time goes on, regardless of what we do to the property. So for those reasons, we're going to be about 75 cents. I'm actually going to lower the price here at about 75 cents on the dollar on this property. We will see how that trades, but this is not a significantly attractive property, not nearly as attractive as the property in Chapel Hill. Of course, that one had another kind of a little hair on it as well with the tax abatement. All right, so now we're going to go to the other property in Marietta, just see if there's anything new to say about that. Is that going to be in the same pocket? Is it in a better area? Let's just take a quick look, and then we'll move on to Georgia X Atlanta. We're going to be moving from next to a couple other deals, not necessarily in Atlanta suburbs, but in what I would call, and for the purposes of these podcasts, I try not to be too specific with the location, just so that we don't dox the property. And these properties are in some of the coastal areas as well as some of middle Georgia. And so they will trade differently depending on where they are, certainly in Georgia. But generally speaking, I will split Georgia into Atlanta and then ex-Atlanta. And then certainly within Atlanta, you have a lot of diversity so far as the type of deal. And then even ex-Atlanta, you've got middle Georgia, you've got coastal markets, you have inland markets, and you have southern Georgia. So there's a bunch of different, and all of those are going to be different. They're all pricing differently. They all have a little bit of a different feel to them, and what demographics they have, what economic drivers they have, and the housing stock. We'll go ahead and pull this one up. I'm going to, like I said, I was going to move to the other one in Marietta. However, looking at this, the property is slightly more attractive, but the area is pretty similar. The lower income pocket, not something that we're really that attracted to acquiring. So again, probably a pass for us. I'd rather pay way more in Northern Atlanta and get much more attractive demographics. Next one, this property I've seen a few times. I believe there was some fires and some insurance issues that had occurred previously. And this one is off market. So I'm going to just note that this one is in Stone Mountain, Georgia. It's roughly 250 units. Previously, we've offered on this property several times in the last couple of years. This was a property that was purchased at the peak in 2021-22. They're all in for about $175 a door, which is an outrageous price for a property of this vintage. Is an 80s vintage deal, and it's currently under a bridge debt. Obviously, the equity's been wiped out, and they were probably just trying to clear the debt. Given the pricing here and what they've spent, we are not currently clearing the debt. I'm sure they're trying to, and their target price is roughly the debt plus 10%. But in this case, we just don't have the wiggle room to get to that number. If I look at the deal otherwise, other than the structural problem, we're looking at twos, mostly 2 2s and 2 1s. That's great for our demographic and what we're looking for families. We're also focused obviously on cash flow and long-term yield, cash flow yield. Other income for the existing property is running a little over 20% of the GCI of the gross income. That's really high for pretty much any property. Additionally, we've got some high insurance. There's been a number of different issues that have occurred to this property. I think that to me is a red flag, and I want to be careful. There's definitely some insurance risk on a property like this. When you've had a shooting, you've had a fire, we got to be careful about that. It's definitely a flag that we'd want to look at. We've assumed a 25% increase in the insurance versus the existing premium, but that may not even be enough. So we'll definitely want to confirm all of that before we get too far in here. Otherwise, we have an offer here. Again, we've offered previously on this property, both off market and when it was previously listed. And right now we're pricing this somewhere about 85 cents on the dollar versus what they want, which is consistent with our prior offers. We haven't seen a lot of changes in the market over these last few years that have really changed what we're able to offer going in, because year 4 yields haven't really changed. If anything, since interest rates went up, yes, NOI has grown, but future rent growth expectations have gone down. Cap rate and expectations in the future have gone down. Generally speaking, valuations, in my opinion, have not moved significantly in the last 12 to 18 months. And now that we're in a potentially a new rate cutting cycle, or at least continuing the rate cutting cycle, we may see that change a little bit here, or at least certain market participants may change their valuation criteria. I don't think it really actually changes anything about what long-term interest rates are going to look like on a sustainable basis. Given that we're long-term holders, we're really focused on what is that long-term 10-year rate, how does that compare to cap rates, and how do we think that's going to look over a 10-year period versus what the 2-year or what the Fed funds is doing. And especially since we're also fixed rate investors, and so we're looking for agency fixed rate debt. We're not going after bridge financing, so we're not as sensitive to what the short end of the curve is doing, except for what it indicates potentially about the underlying economy. That being said, yeah, we're at about 85 cents in the dollar versus the ask, and I feel good about that. But again, we've seen this deal many times before, and I doubt it trades. They're just looking for some indications of value at this point. So now let's move away from, so we looked at some deals in northern Atlanta area. We looked at some ex-Atlanta, Georgia stuff. We looked at a property in North Carolina. Let's go over to Alabama and take a look at two more deals. Actually, we're gonna do one more in Alabama, then we're gonna shoot back over to another market in Georgia, Augusta. So let's go over to Montgomery. That's where we're going now, and see what we can see. We have a number of assets in Alabama. This is a 90s vintage deal, currently marketed 150 to 200 units. Call for offers is basically right now, so we'll go ahead and get something in here. It's like I said, a 90s vintage, almost 1,000 square foot units. This is south of Birmingham, about a 2-hour drive, and there has been some crime on the property. Income is below the threshold at about 50,000 in the 1 mile, 60 in the 3 and the 5. Population growth has been slightly negative, but basically stable, less than 0.2% decline per year for the last 5 years. Schools are well below the average. This is basically a non-starter for us. If I look at it from a valuation perspective, the asking price is roughly a 5.5 cap, a 6.5 cap yield on cost in year 4 is the ask. We're at a point where we want to be almost a 7 cap going in. We'll get to an 8 cap by year 4. The existing sponsor purchased this in 22 and is all in at about 85. That's roughly where I think this property should trade. So that's where we will be, a little bit over the seller's basis on this property. Get a good yield out of the gate, but like I said, it doesn't really much matter what the yield is. If you're in an area with poor schools, low income, you're going to have problems with bad debt. You're going to have problems with your tenants, and generally speaking, when you want to exit, you're going to have limited liquidity on the backside. Good size, like the units, we're looking at mostly, it's about a 50-50 split between 1s and 2s. There is a decent business plan here. However, given the demographics, this is a pass for us. But we're about 20 cents off the ask here. So not too uncommon for this round of deals that most of these are just not a good fit for us. And then we're going to finish off with one other deal that, again, like I said, is in Augusta. I've seen this deal several times before trying to trade off market. We've definitely seen in the last couple of years a lot of deals try to trade off market as people were just trying to test the market, see if they could get a good bid. Now we're at a point where I think people realize that rates are not going to drastically move lower, and they're willing to put perhaps deals on the market and get an actually trade, right? So we saw a lot of deals where people would do a process and they just wouldn't at the end of the day trade, and this is still happening. And we were best and final on a deal recently that we ended up coming in second on, and then the guy who came in first didn't get the deal either. They ended up letting that deal go. They're actually going to relist it again with another broker because they didn't get the price that they wanted. Definitely that's been a recent development since COVID, I would say, that people are a lot less committed to selling, and I think that brokers should start considering adding break fees into their listing agreements, just like they do in the M&A world for operating companies, because there's a lot of time and effort being spent to broker these transactions, and then everyone's left holding the bag, and it doesn't seem like good business practice. So that being said, now, like I said, we're moving over to Augusta. This is a deal we've seen many times before. just hasn't traded. It moved it. Like I said, this is a similar story. This is a property that traded in 21, all in for about $1.65 a square foot, only 120 a unit, but these are relatively small unit sizes. It's one of the reasons I don't love small units, because the price per square foot can feel a little bit out of whack relative to the vintage. This is a 80s vintage deal, and 165 bucks a square foot is a little rich for that vintage, even now or then, certainly. If I look at this overall, we're a little bit closer to the ask. Now, as I said, this particular income here is $80,000. So good income here. The zip code household income is over 90. Schools are 3s, not so great. Don't love that. So I want to be careful about getting too aggressive on a property in this school, in an area with schools of this caliber. Average rent going in is about $1.40 a square foot, going to about $1.53. So not the highest value add potential. There's definitely good affordability in this area, but I'm not thrilled about the schools. Also, the unemployment in Augusta generally is higher than the average for the city, except for the state, as well as the country. So those are some things working against us. We also have our square foot average is below our typical minimum. So for all those reasons, we're not going to be super aggressive on this property. We'll be well below the existing basis. Probably looks like somewhere around, yeah, give or take where the debt is going to trade. So if they're currently in their bridge note, our price is roughly clearing the debt. But at that level, we got nice yield, and we're definitely seeing higher expenses for our ownership period versus the prior sponsor. And we would want to be going in at about a 6.25 cap here. Seller's looking to sell at about a 5.25. That just doesn't work for us in today's market, and very difficult to square that with where interest rates are. Yeah, that's our last deal for today. And hopefully next week we'll have a better round of deals that are more in line with our desired demographics, our average square footage, our unit mix, those sorts of things. But we can't force it. Deals will come, and when we see one that we like, we'll become more aggressive and be able to make those deals happen.